Welcome to the Classical Charts and Swing Trading Blogcast.
Hey guys. So, I haven't made any episodes recently, mainly due to work. It's been extremely busy. I've been working every day for the past 25, 26, 27 days. So, that's been the main reason, but I guess another reason is that I've been probably a bit too perfectionist with my recordings. There's some background noise. Oh, better re-record. I mispronounced this word. Oop, better re-record. Accidentally farted. Oop, better record. So I'm sort of going to take a less perfectionist approach this time. I'm going to make mistakes. I'm going to say a lot of ums and ahs, and I'll probably take a long time to get a sentence out. That's sort of just how I am in real life, so hope you all bear with me. Because that's what's going to allow me to get more episodes out without worrying too much about the quality of the recording and sort of taking the fun out of it. So, now with that being said, I guess I can get started with the episode. The topic for this episode is the only two things that matter for trading profitability: success rate and average win to average loss ratio. So in my opinion, your analysis approach, whether you use macro analysis or value investing or technical analysis, that's not important in terms of finding your path towards trading profitability. Neither is the trading instrument you use, whether you use options or forex or futures or just buy equities outright. That's not important. Even the asset class you trade is not important. You can use bonds, currencies, equities, crypto, commodities. These are not the most important things. Sure, they do contribute, but I'm sure you all know, as well as I do, that there are profitable traders and investors using a whole variety of different approaches, trading instruments, asset classes, and they manage to be successful doing completely different things. So I like to simplify things, and to me, if I really try to get to the fundamental principles of trading profitability, it comes down to two things, which is your success rate of your trading and your average win to average loss ratio. That is what actually matters. It's mathematically impossible to actually improve your trading performance without seeing either of these two things improve. Either or both of these two things. So, at the beginning, most people concentrate on the success rate. So, it's all about analysis. It's all about your entry signals. It's all about trying to get that 95% success rate. And that's sort of how we are that's how it's been wired into us. Like, to succeed at school, you have to get more than 50% correct, and the more you get correct, the better your grade. When you start work, it's all about being able to make as little mistakes as you can. That's what's going to make your boss happy. I guess it depends on what boss you have. Maybe some of them are never happy. Make them less grumpy, I guess. So, that's what a lot of people focus on initially. And then the next focus, I believe, is on asymmetry, more specifically trying to make a lot of money compared to the losses. So make a lot of money when you're right compared to the amount you lose when you're wrong. And it's really focusing on making more money. So you're looking at the 10 bag is the asymmetry, Bitcoin going up 100x, that sort of thing. Now, the third thing that I see a lot less people concentrate on, but is really the last component of these two factors. So the first factor being success rate, the second factor being the average win to average loss ratio. very few people, at least I believe, concentrate on the denominator, which is the average loss. So I came to the realization that mathematically it was the same thing. If you can reduce your losses, your average win to average loss ratio will improve just as well as if you just focus on improving the size of your winners. So this kind of got me interested, and now this is actually my current focus because I believe it's the road less traveled. I believe that if I, as a retail trader, focus on this, I can build a niche out in here, and it's really where nobody is looking where you'll find the most value, isn't it? So that's sort of my thinking right now. And as to my journey in how I came to this sort of realization, well, I started out just like everybody else. In 2013, I went to a weekend seminar, one of those get rich quick ones. It was a property one. But there were a couple of speakers, and one of the guys was a trader. And he talked about how wonderful selling naked options was. So a lot of you guys probably already know where this is heading. But for me, I sort of listened and I thought, hey, that sounds sort of interesting. And I actually met somebody who was a brother of a friend of mine. And he said, yeah, I've been doing it for nearly a year and it's really working out. It's not a scam. And so I decided to take the leap. I signed up for his 3-day seminar, and I started selling options, and I did quite well initially. I had something like a 95% success rate for close to a year. And then had a little bit of a market correction. A little market correction, but massive losses. It had a lot to do with the amount of leverage that I was using as well, but I lost 5 figures. It was a pretty big loss. And it was a bit shocking, honestly, because I still had something like a 90% success rate. So me just looking at the results, I was like scratching my head. How could I do so poorly with such a high success rate? So obviously the success rate is not the key here. So then I I went to more seminars. You keep doing what doesn't work, I guess. It's human nature, isn't it? So I moved into sort of more macro analysis and fundamental analysis, and I bought into the narrative of rates rising during the taper tantrum of 2013. That's sort of when the quantitative easing was tapering in terms of the purchase of bonds, and yields started to rise. And what I actually did was I levered up into a leveraged inverse ETF that tried to track the bond prices, as in if bond prices went down, then the CFD or the ETF went up. Now, once again, I'm sure a lot of you guys can probably see where this is going, but I thought about it, and I saw huge upside asymmetry in it. Like, bond prices were historically quite high and interest rates were quite low, and it seemed like the momentum was going in a way which would see interest rates go much higher. So, this is before interest rates got even lower. But at the time, it looked like it had huge asymmetry. It looked like I could make a lot of money compared to what I would lose. So I was focusing on the asymmetry. And well, guess bonds didn't actually have to crash, and guess like inflation wasn't an inevitability, and turns out rates can go much, much lower than what they were in 2013. And so the potential, keyword potential, asymmetric profits did not actually end up being realized. So even though I was starting to wisen up to the fact that success rate is not the most important factor, that the average win to average loss ratio is probably something that as a retail trader I should be focusing on more. Even though I wisened up to these things, it did not result in a favorable outcome for me. So it was back to the drawing board. I looked at success rate, didn't work. I looked at the numerator of the average win to average loss ratio, didn't quite work as well, because at the end of the day, those were just potential asymmetric profits. So after taking another big loss, it was back to the drawing board. But I was determined to sort of see it through, and so I continued to work on my approach trading using a long vol approach, buying options, long-term options, leaps. And after years of more mediocre results, I started to realize that trying to control my success rate and also trying to control the magnitude of my winners, neither of these two options were really what I was adept at. And so I kept searching, and that's when I came across classical charting from Real Vision. And, I approached it with a lot of skepticism, because I always sort of saw technical analysis as a bit of voodoo magic that I didn't really care for. It just was a lot more intellectually fulfilling, I think, to do the analysis and then profit from your intelligence and your analysis, rather than just trying to identify pretty shapes in a chart and make money like that. So, for years I'd heard the cliches like cut your losers short, ride your winners, risk management is key, don't lose money, all that sort of thing. And I, nodded my head wisely or sagely and said, yeah, I agree, that's true, yep, that's what I do, But it was only really when I came across classical charting that I realized that I could actually be a lot more disciplined and efficient and effective in managing my losses. It's really following Peter Brandt's factor report or factor service. I can't remember exactly what it's called now. Factor something. That sort of really opened my eyes as to how much more I could do with managing losses and focusing on the denominator of that average win to average loss ratio. And that's when I really got into classical charting, because it provided a framework with which I could control my losers and really focus on that average loss portion of that ratio. And it's really because you can objectively judge when a trade does not meet your criteria, your trading criteria, and quickly cut it. There's no ifs, ands, or buts. It's if that pattern no longer holds, you just get out. Or even if that pattern doesn't fulfill your expectations within a short time period, you can begin to cut it already. And that really helps to sort of get you into the mindset of just controlling your losers. And having done it for about 18 months now, I sort of realized this was actually something that I could become adept at. This is something I actually feel comfortable with and resonates with me, and I think that is also very important when it comes to trading. So that's sort of my story and where I'm at now. I'd love to hear where you guys are at and whether or not you agree with what I'm saying. But in my opinion, at the end of the day, the only two things that matter is improving either your success rate or your average win to average loss ratio. And for me, the path that I've chosen is to focus on the average loss ratio. So that might actually seem really obvious. Okay, yeah, no shit, Sherlock. Those two things are, the only ways you can improve your trading performance. The sun is hot, so what? So what I would want to sort of leave you guys with is, okay, the sun is hot. How can I practically use this to improve my life? Well, you can hang your wet clothes out in the sun, and when it comes to this idea of success rate and average win to average loss ratio being the only things that can actually improve your trading at the end of the day, well, I would say perhaps a useful thing that we can all do is, first of all, you define all your trading activities, and then you cut out all the activities which do not directly or even indirectly contribute to these two factors. If it doesn't improve your success rate, or if it doesn't improve your average win to average loss ratio, maybe you should spend less time on it. And then when you've cut out all the fat, all the things that are not useful, you can focus your time and energy on the things that contribute to these two factors the most, and prioritize those and try to allocate your time so that you're putting the majority of your time in the things that give you the majority of the results when it comes to your success rate and your average win to average loss ratio. So I hope you guys enjoyed that. That is essentially what I wanted to get across for this episode. So it's 9:46 p.m. on a Friday night, 23rd of October 2020, and thank you for joining me on my journey in search of trading success.